Hello guys, welcome back to a new video. And today's video I want to answer a very important question which came from the video I made yesterday, and a gentleman over here had asked, can you please make a video showing us how to calculate pips or how to risk 2% on any account, please. Now before I continue, I'm going to show you exactly how it works. However, what I do want to let you know is 2% risk is too much exposure. Now, I'm going to explain this as very easy and basic as I can, and I'll also tell you what the best risk would be in terms of your overall exposure. And if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoyed the video, please do consider hitting that thumbs up button as well. Now, as we know, risk management and the discipline in general is one of the most key contributing factors that is required to become a successful trader. And why do I say so? Information on how to buy and sell and trade is available for free on the internet, right? I know it, you know it. You go onto certain Telegram groups, you'll find that people you can get anybody's course nowadays for free on YouTube. All of the information is available out there for free. But what is not available out there is your behavior. That's your attitude. It's how you behave, which has got a lot to do with trading psychology. Now, trading psychology has got a direct correlation with risk management, because if you manage your risk correctly, you wouldn't need to worry about feeling getting that mini heart attacks if your account runs into a drawdown. So that's kind of the important thing. So that's why I'm making the video, because whenever someone asks me about the risk management, I always want to answer the question to the best of my ability. Now, firstly, a 2% risk is not where you want to be. You ideally want to risk 1%. So why do I say that a 1% risk is ideal? Because think about it in this way, right? And you will always want to be at a 1 to 2, 1 to 3, because you always want to make sure that your reward is higher than your risk. So a 1 to 3 will look something like this, and a 1 to 2 risk to reward will look something like this. Okay, what does this what does these numbers mean? It basically means that we are risking 1% of the account to make 2%, to make double. And the first one means that we're risking 1% to make 3 times the amount that we are risking back. Now, let's assume you're trading a $100,000 funded account, or you're trading a $100,000 account, because somewhere you've got $100,000 in your bank account, and that is why you want to be invested in trading. But let's assume you've got 100,000, and for some reason you risk 1%. That means you are now risking $1,000 to make either the 2%, which will be 2,000, or the 3%, which would be 3,000. But if you are risking 2%, that means you'd be making 4,000 if your stop loss hits. Sorry, if your take profit hits. So you'd be making 6,000 if your stop loss hits on the 1 to 3, but you'd be losing 2,000 because you've risked you've risked a 2%. So how is this risk calculated? Now, there's two things that you need to understand. Now, in my signals group or signals chat, risk management has always been a contributing factor. Now, I trade a couple of funded accounts. I trade about 4 funded accounts, right? And my risk on these funded accounts is normally 0.25%. Why? Because a 0.25% risk on a $25,000 funded account compared to a one is a lot more than even a 1% risk on a 1,000 Rand account. So for me, it's all about consistency, being profitable. I don't want to become overnight millionaire, because I've never earned $1 million when I was working. For me, it's just to make sure that I make more than what I used to earn when I was still working. So the idea behind risk management is understanding exactly how much it is that you're going to lose. Now, let's assume that you decide to take a trade, and we're going to use Euro JPY as an example, but I'm going to use a different chart because I need this was part of yesterday's breakdown. But let's assume that this is the trade that you want to take. Now remember, this applies for everything out there. Now you've obviously already done the math, okay? So you're like, okay, I want to sell Euro JPY to this level over here, okay, and I want my stop loss to be there, okay? So your entry would be at that price. Now these are things that you need to do before you take a trade, because these are the things that's going to make you feel more comfortable with taking the trade, knowing how much it is that you're going to lose. If the guy that you bought signals from says, guy, stop loss had hit, you go like, it's fine, I've only lost 0.25% of I only lost 1%. Now the easiest way to do this is very simple. Now on TradingView you get a tool called a risk to reward tool, which I normally tend to use, and this is the easiest way to do it, as opposed to counting how many pips the difference is between the entry and the stop loss, because that's basically where your percentage risk come from. So we're basically saying that this here is a 1% risk and this over here is a 3% gain, hypothetically speaking. Now what you want to do is you want to come over to the third, you want to count 1 2 3, you want to come over to the third one, and let me just check if it's here, because I've got it on my list over here. Sorry, you want to count 1 2 3 4 5 6 7 here, I think, and then you would want to select the short position tool. The short position tool is basically because we are looking for a sell. All you basically do is you just put your your short position tool down. What you want to do is you want to enter, like you want to get the pricing and you want to double click on it, right? Then you put in your pricing, or you can just drag it to where you want it to be, and then that is where your stop loss is going to be. Now if you look at this here, it says the risk to reward, it says 2.86. That means that we are risking 1% to make 2.86. Now if you wanted to risk a 3%, you would then reduce the risk, and then that would be a 3% risk to reward. Now the question is, how many pips are you risking? So basically there you can see there where it says 97.5, if you round that off you get about 98. That means you are risking 98 pips to make the 298, as you can see at the bottom. Okay, so this basically tells us this is a 1 to 3 risk to reward. Now if you had to go and risk 2%, your risk would be slightly higher, so that would be a 2. Now you're saying that you are risking 1% to make 2%, because this is now a 1 to 2 risk to reward. Then you can see how your stop loss had now increased. Now to put this for you in layman's terms, so we're going to come back to how do you know which lot size to trade based off that. So now that you know that before you take a trade, and this applies for everyone's favorite and everyone's reason for still not being successful in trading, because they follow the trend. I was watching a video yesterday of someone who said that they only trade indices. That's it, like they only trade indices. And I'm not a big fan of indices, and I'm not saying don't trade it. I'm not a big fan of that, because because of the per pip value and the fact that it can wipe your account out very quickly. I do trade them now and then, I do send signals for them, but it's not a personal favorite for me from an investor's perspective. But I don't say stay away from it. I would advise you, if you don't have a large capital, just stay away from it, because you're just going to use your hard-earned money hoping that you'd make a lot of money also. Now let's take it a step back. Let's go back into it. You come onto the chart. What you want to do is you want to go to this tool. There's a long position tool and a short position tool. You click it where you want to enter, you drag it where you want your take profit to be, and you drag it where you want your stop loss to be. Again, as you see, as we're moving this, these numbers are moving. Now what you can see over there is you don't see the 1, but this means it's 1 to 3.42 risk to reward. What you want to do is you always want to make sure that you don't go below the 2. The minute you go below the 2, that means you are basically you are risking a 1 to make just over 1%. Once you get to 2, you're now risking 1% to make 2.25%, and then so on and so forth. This means that you are risking 1% to make 15.35%. But what you'll notice is that as your stop loss pips decreases in value, your total lot sizes will increase because the risk now becomes less. But because the pips are now less, that means that your lot size will increase, but you will still lose the same amount of money. Now, let's assume that you trade a 1 to 3 risk to reward, which is the default, right? But before you trade a 1 to 3, you want to make sure that you get your you want to get into your entry price, and you want to get your stop loss wherever it is that you need to set it, and you get your take profit. And what you want to do is if you want to trade a 1 to 3, always scale it so that it says there 3, and that will give us an indication that we are trading a 1 to 3 risk to reward. Now that you have this information, the next thing you want to do is you want to go over to a position size calculator. This is how you see exactly how much you are going to risk. Now we know we are risking a 1% to make 3%. Remember, you never want this risk to reward ratio to drop below a 1. It can be a 1 to 1, but that means you're risking 1% to make a 1% gain, which is not beneficial. I would say 2%, 3%, 15%, 20%. That is where you want to be, right? Once you've done this, what you want to do now is you want to know what lot size to use that is equivalent to 1% of your account. Now you go to babypips.com position size calculator, right? You will fall onto this page. Basically, if you go to Baby Pips, you fall there, you go to tools, and you go to position size calculator. What you want to come down to is you'll see there it says account balance. This is basically where you put in your account balance, basically how much you have in your account. Let's assume that you have $1,000 in your trading account. Now they're going to ask you how much would you like to risk of your account. You're going to say, okay, I'm comfortable risking 1%. That means because this is a 1 to 3 risk to reward, that means that you are risking 1% of your account because you want to make 3% of your account. Now they're going to ask you what is the stop loss in pips. You want to go back there, you want to keep your mouse over this tool, and there is the amount of pips, which is 100. So we're going to go there and say stop loss pips is going to be 100, and we're going to go down here and you're going to select Euro JPY, and they're going to ask you what is the current price for USD JPY. Then basically you just head over to USD JPY, and you basically want to go and see here it says 129.762. you go there and say 129.762, then you're going to say calculate, right? So now you can see here they've given you the results. After you click calculate, it says there the amount that you are risking is $10. The lot size that you need to use is supposed to be a 0.013 or a 0.01. Okay, this is if you trade a mini account, and this is if you trade a micro account. Now you know that you are going to risk $10 of your $1,000 balance. Now what is going to happen is if you have $1,000 and let's say you lose 1%, you will have $990 left. But if you have $1,000 and you win 3%, which is what the reward is going to be, that means you are going to make $30 on the account, meaning that you will be at $1,030. That is how it basically works. Now, this is how you basically calculate the risk to reward, or 2% of the account. We can use a similar example on USD JPY. We're gonna, if let's say we want to buy, and we want to maybe buy USD JPY to that level, all you do is you come here and you put your buy to your long tool in there. You drag the take profit to where the take profit is going to be. You move your stop loss to where you want your stop loss to be. But if you're just looking for 1 to 3, just make sure that you get a 3 there, and and then basically drag that to a 3. There you go. And then now you're good to go to buy. What do you do now is you come over here and you put in your balance, you put in your risk percentage, you say I want to risk 1%, you say stop loss pips is here, it's 96, 96.4, but we're going to say 96 unless it was 96.5, we round it off to 97, and then we go over here and we say USD, JPY, and then it will ask you what the current price is, and you just say again, and there you can say that says this for as a standard lot account you need to use 0.0135. Now that is how you calculate the risk to reward. The risk to reward is calculated by either using a risk to reward tool, or you can always look at the price and then deduct the entry from the stop loss. But my best advice would be to use this risk to reward tool on TradingView, because it does give you it makes things a lot easier for you. And if you want to know what you're going to lose, come and use this baby pips tool. This one over here is also a trading tool, but this is normally for indices, and you can see it's normally for indices. You can use it for indices and precious metals. You can use it over here. But if you want to take my advice, and a lot of people are not going to agree with me, but it's okay. Don't be that person to just want to trade indices. I'm not saying it is wrong to only trade indices, but if you look at it from a realistic point of view, right? So if again, it's got a lot to do with capital, but if you look at trading only indices, indices is one of the biggest gamble that you can take, because these accounts are so small that if you get one trade wrong, you could potentially lose everything, or if you get one trade right, you'd be able to take a screenshot and post it on Instagram. But if you get it wrong and then you don't do it, but yeah, so if you get it right, you're lucky enough, you qualify to take the screenshot. But if you don't, then that's not how it works. The thrill of having a trade running, knowing how much you're going to lose, knowing how much you're going to win, understanding that your risk was calculated, that you're not concerned about that, is probably one of the best feelings that you will ever find in this world. Because why? It gives you that comfort of knowing that this is how much I'm going to lose, and I'm basically okay with losing it. But when you trade indices, you deposited 1,000 Rand, you're trading a 0.01. I guarantee you don't know how much you are risking. You don't know. Do you think those guys that are sending those indices signals only, like the Nasdaq guys, for instance, right? Or US 30 kids on the block, do you think these guys really care about telling you how much you have to risk? Because all you see nowadays is TP open, SL open, we killed NFP, we killed FOMC, you kill everything, but this stuff just keeps coming back up. So at the end of the day, if you think it's funny, if you think it's funny to deposit money into your account for the thrill of the 3:30 session, if you think it's funny, then yes, be a clown. It's fine, you can be a clown. But the market is not for people that think you can deposit 1,000 and then 3:30 come, now you want to put in a trade. No. Sometimes I'm sleeping 3:30. When the NFP plays through, I'm probably sleeping sometimes when the NFP comes. Sometimes I'm sleeping when the interest rate, and I can guarantee you there's a lot of people out there who are trading these news outcomes for the thrill of it. Now, because of that thrill, you have to set your alarm to go to work the next day. Because of that thrill, you have to now reduce your signal prices, where you charge less for your monthly than what you do for your lifetime, because you're so messed up in your head with not knowing how to trade and with your marketing tactics that you don't even know how to price your stuff anymore. Now, I've said this before and I will say it again. Always risk enough so that you can stay in the game for long. Trading is like Hunger Games. Not everyone makes it out here alive. And for those greedy people out there, you're probably still trying to be profitable in the market. That is it from my side. Thank you for your time. And as always, cheers for ears.